Good evening, everyone. Welcome back to the channel. So, one recommendation I would make for those of you that are really serious about your finances and stuff like that, which is, I'd say, all of this audience, you may want to think about canceling your Netflix, cancel some of your streaming apps and stuff like that, because you have a financial coaching channel to watch. And like some of you've commented, it's more valuable as a use of your time to watch this channel than it is to watch whatever, mindless shows are on TV. So I know for me, one thing I've done this year, I've cut way back on watching shows and stuff like that because I'm a content creator. So between that, being out doing things and whatnot, a lot less time for TV. With that being said, I'm going to try something different for this evening's video. I'm going to try to debunk some common misconceptions about the ETFs we've been talking about recently, because there are a lot of them. And some of them may even come from me, actually, because I read every comment that I get and I try to respond to every comment. It's starting to get a little harder because more of them are coming in, which is a good thing. Keep that coming. Um, but yeah, so I'm going to probably spend 10 to 15 minutes doing that. We'll see what kind of live viewership we get. And then if I get a lot of you on here, which I kind of anticipate, uh, I'll just let the audience direct the discussion like I've been doing. So the first couple things I want to point out, and this will just be me talking, I'm not going to share a screen or anything, but just off the top of my head from what I've read in the comments, there's a lot of different, I guess, misconceptions or different schools of thought about how covered call ETFs work. One thing, I got a comment that kind of made me think today, because the commenter said the more people that invest in these funds. All right, first live viewer. Thanks for showing up. So one of the commenters, it may have been you, I can't remember if it was, but you leave a lot of good comments too. But the commenter said, why would the option premiums go down if more people are investing? If more people are investing, that means the fund has more money to generate more premiums. And I can follow the logic of that comment, but I'm not quite sure that that's how it works. Because remember, the fund is selling uh, the options to generate the premium. So I guess to do the covered calls, it could buy more of the underlying stock or do the PMCC strategy, the poor man's covered call, if it has more funds. But I'm not quite sure if the amount of assets under management or capital that the funds have lead to better premiums per se. One of the other things, and this is a very common misconception uh, for all three of them, for the OARK. Well, one thing before I get into that, one thing I'll get out of the way, and this was my misconception: OARK is not an inverse Cathie Wood ETF, and I'll take first and foremost, I'll take ownership of that because I errantly said that in a video. It's really not an inverse Cathie Wood ETF. There is one that somebody put in the comments. Uh, I'm not quite sure what the name was, but OARK should be correlated to Cathie Wood's fund selling covered calls. I think someone or a couple people in the comments may have said that, and I picked up on it because they thought, oh, because it's selling covered calls, it must be an inverse fund. And that was a misconception with some of the earlier ones like JEPQ, QYLD, things like that. Like some people even thought it was like an inverse NASDAQ fund. It's not. It should ideally move in the same direction, but not quite as much because remember, you're generating a premium. So, all right, second live commenter here. Howdy, how are you doing? So we're just clearing up misconceptions about these popular ETFs. So yeah, that's one. So the Cathie Wood Fund, ARK, ARKK, ARK. The OARK is not it's not an inverse fund, but there are plenty of inverse funds, and one that I want to talk about, the inverse Kramer fund. I was going to dedicate a separate video to that actually yesterday, but that one's still in the queue. I'm going to have a lot of fun with that one. I've got a thumbnail like with a clown nose and clown hat for Mr. Kramer, so I'm gonna have fun. I'm gonna mop the floor with that one because, like I said, Kramer has cost me some money too, so I have a personal axe to grind on that one. So let me see. OARK. It went up today, but I think all three of them got hit pretty hard this week, especially TSLY. APLY is down a little bit from where it was the day before. TSLY actually rebounded a little bit today. It's 1347. Wish I would have just waited a couple days. But here's the thing with earnings for Tesla, it's like flipping a coin. Honestly, you don't know unless you're an insider. You really don't know. Now, a lot of you did predict that Tesla was going to miss earnings. So I give you credit there. But you just don't know. That's the thing. So, I bought in Monday and I'm down probably 5 to 10%, but I'm bullish on it long term. But as far as the panic, another misconception I want to clear up, because like I said, I've been following all the comments and a lot of you go back and forth, which is good. We have good, vibrant discussion on this channel. So the hysteria about the funds dropping abruptly, because people are looking back to November and December and they're saying TSLY has dropped a lot. Well, again, if you follow the video I did a couple of videos ago, and I could even do it again here, uh, the Tesla chart and the TSLY chart pretty much directly parallel each other. So I lost two of you. Wonder why. I was up to three, but if we keep going up, remember, the more of you tune in, the longer that I go. That's the one. Thank you. SARK is the inverse fund for ARKK. So there you have it. That's the one. So SARK, let me look at that one on my phone real quick here. Ooh, that one is 4277. I guess that makes sense. If it's an inverse fund, because Kathy Wood's fund has been crushed. So I like the idea of participating in an inverse Kathy Wood fund. So good call on that one. There must be a delay in the comments here because it's 10:30 and I just now saw that second one. So there must be some kind of delay. All right, four of you now. So anyway, yeah, the whole idea about these funds dropping dramatically, there's a lot of fear around that, but I don't think that's going to be the case. The reason that happened in TSLY and even OARK is because of the performance of the underlying fund, which is kind of weird if you think about it, because so not only do we have not only do we have indexed ETFs, or I'm sorry, not only do we have ETFs indexed for stocks, but we have ETFs indexed for other ETFs now. So it's kind of like, I don't know if that's what you would call the derivative game or what, but it's kind of really getting interesting how that works. Let's see what we got here. Tesla dropped prices on at least one of their vehicles, so the assumption was that earnings would be less. Now, why is that? Oh, because of a lower price. That makes sense. See, for me, I don't follow the costs of their vehicles and stuff. I just know they're too high. So I kind of tune it out because I haven't been in the market for electrical vehicles. Again, and no one's addressed this, but we had the whole thing in Florida with, the hurricane we had back in September. A lot of those Teslas were blowing up in the storm surge. So I don't know if that's something they've ironed out yet, but a lot of you California people, I know you're very bullish on Tesla. I am too. I just don't know if I would own one yet because I've seen more than one of them blow up. So that is a little concerning. And with that, looks like we just lost two Tesla fans, even though I said I was bullish on Tesla. But okay, so OARK. So we're debunking theory number 3, I think, for those of you keeping track at home. So OARK also opened up like $20 a share, went up to 21.26, and it's down to 15.40. So naturally, a lot of you following these funds, you're thinking, well, OARK dropped by $6 a share. TSLY dropped by more than that, like by $7 or $8 a share from where it was. Let's see. It was 21.76. It dropped to 13.47. So that's, let's see, 14, 15, 16, 17, 18, 19, 20. So almost $8 a share. So I can understand where some of the hysteria comes from. But, and some of you are thinking that that's going to happen with Apple too. Now, like another commenter pointed out, Apple is a very stable stock compared to Kathy Wood's and compared to TSLY. So for those of you that are thinking the same thing's going to happen with Apple, I don't necessarily think that's going to be the case. Now, I know some of you believe that the covered calls that are paid out are dropping the price of the ETF. That can be the case, but we'll have to see what the dividend is going to be with APLY. I don't necessarily think that it's going to be so high that it tanks the price of that stock. Because again, Apple, and we'll go into Yahoo Finance and look at that. But Apple, relatively speaking, compared to these other two, is a very stable stock. And I'm waiting for Apple's next big run. I think it should be coming soon. So let's see here. Let's go to Yahoo Finance. And you said, I see people waiting an hour plus to charge their Tesla. Yes, so much for that technology being perfected, right? It's a work in progress. But you know what? Speaking of spending hours, I like a lot of the viewers on this channel spend an hour on my live stream. So I guess some of you, while you're waiting for your Tesla to charge, you could just watch the live stream here. That'll make the time pass because we have a lot of fun here. So anyway, share screen, Yahoo Finance. And let's see. And I have to say, it makes it a lot more interesting with live participation for sure. It kind of helps guide me, keep me on point as to where I can go and keeps me focused because I tend to have ADD sometimes. So anyway, Yahoo Finance, let's look at Apple. So we're still, for those keeping track at home, we're still invalidating theory number 3. And I think there's a number 4 and a number 5. So Apple was down to 165 today. It lost about 1%. But if you look at the chart here, which is going to pop up here in the middle next to this Ticketmaster ad, what you're going to see is a little choppiness, but you're going to see a 52-week low at 131 or 129, and then so that is kind of that's about a $30 range that Apple is trading at. So a little more volatile than I thought. And I'm a shareholder in Apple. I don't have much, but the dumbest thing I did, I got out in 2017. I used the money to put a down payment on a house, but should have definitely stayed in because the Apple stock that I sold out of in 2017, I was in for that split that happened like in 2014. It was like a 7-for-1 split. It was like one of the first stocks I ever bought, but I was in for that, and it became a nice chunk of change. I think probably 6 or 7,000 grew to like basically enough for a down payment on a house, like 20,000 or so. But yeah, shouldn't have sold that. Should have just done that FHA loan like everybody else does. But I'm kind of stubborn about debt. That's just how I am. But it's getting to where the way our society is now, debt really doesn't matter. Everybody seems to be in debt. But I'm still going to stick to my guns on that, even if I'm in the minority. So Apple does pay a dividend. It's like 92 cents or just over 0.5%. Earnings date is May 4th, one of our favorite days for Star Wars fans, right? May the 4th be with you. Also, the day that this channel got monetized, which is really cool. And that's definitely coincidence. Let's see what we got here. Another comment. Okay, Join Jen thinks, I think APLY will be good long-term because the underlying asset is a great company. I 100% agree, and it's less volatile. But I was actually trying to come up with a percentage here. So we went from 165 to 129. That's a $36 swing. So Apple has fluctuated about 28%. Now I want to do the same calculation for Tesla stock because I agree, Apple's very solid. I wish they'd buy Disney too. They've got the market cap. They're up to 2.61 trillion. They're one of the highest value companies, if not the highest in the world. Now let's go to Tesla, our favorite. Got Tesla. I think we came back a little bit. Now look at that. Is that coincidence or not? Do my eyes deceive me here? Other than getting another Chili's ad? I mean, these two prices are almost identical. Look at that. I'm gonna have to play Lotto. That's scary. I didn't realize Apple and Tesla are trading at almost the same. They are trading at the same dollar amount. They're 6 cents apart. Wow, isn't that something? I almost thought my page didn't refresh. And if you look in the after hours, Apple and Tesla are 1 cent off in the after hours. Who's up for playing Lotto now? Because that's what financially savvy people do, right? We play Lotto. We participate in that tax on the poor. Actually, I do. It's funny because side story here, but like when the Powerball gets up higher, everybody thinks like, oh, go play Lotto because for some reason when the pot is higher, that somehow increases our chances of winning, right? I've never understood that logic, but I can't say I haven't partaken in it too. It's kind of like a spectacle, a frenzy. So, but that's pretty mind-boggling that those two stocks at this point, to think that Apple and Tesla are trading at the same dollar amount. And let's see. Apple with a high monthly income should be a winner. Oh yeah, because I mean you're going to get a much better dividend than what you get in Apple stock. But Tesla doesn't pay a dividend. You have to be in TSLY to get the dividend. So, and like I pointed out, the performance of TSLY from the start of the year, if you look at it, if you combine the dividend yield to the stock payout, or not the stock payout, but if you combine like the overall ROI, year to date earnings, am I saying that right? Yeah, the return on investment, the ROI for the ETF, and you add that to the dividend payout, in terms of total return, we're not far off from Tesla stock for a fraction of the cost. It's like 15, it's like 1/15 or 1/12 of the cost. So if you want to get in on the Tesla earnings for, or if you want to get in on the Tesla the next bull run of Tesla for a lot cheaper, there you go. So now let's look at Tesla, and I'm still blown away that both stocks are the same, basically the same price, give or take like 1 cent. Um, so yeah, Tesla again, there's no dividend, but the fluctuation in Tesla, and again, for those keeping track at home, we're still invalidating. Is this what I call this conspiracy theory or myth? Um, Either one, it's still number 3 that we're on, so we're still invalidating that one. This one is going to completely invalidate it when I get this statement out. So Tesla, the key point here is that in the same amount of time, so yeah, Apple's fluctuated $30 a share, but Tesla has fluctuated. It was at a peak of $303 a share, September 12th, 303.35 to be exact. It's at 165.09 today. So that's $138. If you divide that by the low point, which will count, actually, no, we can't do it that way. The total swing, the low point was 113, so it's going to make this even more profound. So what did we say? 303, 303 up here, 303 minus 113. Wow, so it lost like 190 divided by 113. Yeah, it lost like 168% of that value. Or if you go from the 303, what do we say again here? 303 minus 113, 190 divided by 303. So that's 63% from the peak. So long story short, Tesla is even more volatile than Apple. So you can't compare TSLY to APLY. APLY, I believe, is going to be much more stable. And for those of you that like diversification and like the stability of being in multiple funds, you may get it just within this YieldMax fund family. Because, so you're going to have your volatile one with TSLY, your Cathie Wood fund, the OARK. I forget what the O stands for in that. But the stable one is going to come in terms of Apple. And from what I understand, NVIDIA, their fund, NVDY, is on the way within the next month or so. So you could have 4 funds that, and you could get that hedging, so to speak, because you could have the stable one with APLY, with less fluctuation, right? Now, the example I gave with Tesla, which at this point really blows a hole in that theory about all of these performing the same, all of these being super volatile. You can see Tesla is the most volatile. And if you look at the 52-week range, it's even more profound than the example I just gave, because really the 52-week low is 101.81. The 52-week high is 336.21 when you factor in intraday trading. So 336.21 minus 101.81 is 234 divided by 101.81. That's like a 230% if you're doing that based on the base amount, or 336.21 minus 101.81 divided by 336.21. That's a 70% swing from the peak if you take the peak price as the denominator in that. So now let's look at OARK, and then I'll swing back over to the page here and check any other comments we have. So OARK, because this is based on the Cathie Wood ETF, and it's directly correlated rather than being inversely correlated. You're going to see the same thing. 2002 peaked at 21.26. The bottom was 14.94, March 10th. So it's come back like $1. But yeah, what point am I trying to make here? So Yeah, you're going to see, like I said, it's performed similar to TSLY because the underlying, in this case, ETF is a lot more volatile. Let's just look at ARK just to show the example here, and then I'll swing back for comments. So Kathy Wood's ARK Innovation Fund is actually up 20% for the year. Now, unbeknownst even to me, because I'm just now looking at this fund has been around since 2014, and it didn't really have a significant run up until what started running up in in wow, during the Trump years, basically, which is funny. Well, the whole market was going up during the Trump years, but I just find it kind of funny because like everything that, not to get political, but like everything that he would have kind of been against, basically, like all the tech companies, they all ran up during his presidency, and now that he's gone, like they've all crashed. So it's kind of ironic. But really, the Kathy Wood ARK Innovation Fund just really shot up during that crazy COVID market, like from the start of the pandemic all the way to February, which really, that's a lot of things peaked out in February when that second stimulus bill got passed. You can almost tie that directly to like stimulus checks because I think a lot of like the AMC, the meme stock crowd, I think they invested in this fund too. But I guess that's a way to boost the stock market, just give out more stimulus checks. But I wish there's a lot of things I wish I would have sold around that time, including Disney stock. All right, well, let me circle back to the comments here. So let's see here. We got 10 of you now, but only 2 of you are commenting so far. So we need some comments out of the other 8 of you. So come on, bring them. Okay, only one. Oh, wait a second. No, I've covered all the comments because this was the last one. So all right, I need more comments. Yeah, I covered this last one. So I'm kind of rambling here on Yahoo Finance, but basically, those are the 3 main myths I wanted to debunk. The other one, I guess, number 4, would be about the dividends that they're going to drop as the stock drops. Well, it depends. And I've still got to look into those other 2 bond ones from the other video because we actually just had our highest payout. And I'm going to probably just need one of you in the comments to explain that to me because I don't understand those funds that probably half of you ask about, like the TLTW and what's the other one, HYLG or HYGL. Those 2 bond ETFs. Those I just don't understand how their strategy works. So some of you in the comments are just going to have to explain that to me because I just looked at TLTW, and when I predicted that the dividend would continue to drop, it just had its highest dividend. And this is, keep in mind, after bond yields have basically peaked out. We're not getting like what we got in the I series last year. So bond yields have basically peaked out. And well, let's look at it. You know what? Since I'm on Yahoo, let's look at it. We beat up Kathy Wood's fund enough. Let me, just to be random here, I got to look up this inverse Kramer tracker. This is a fun one. I'm going to do a separate video on this, but I'm going to have a lot of fun with that one. So it's called SGIM, like Slim Jim, as in his returns, slim returns. And I think this one's only been public for like a month or so, but I like it. I mean, I love the premise behind this fund. Peaked out in March 17th, St. Patty's Day, and it's kind of been dropping since then. So yeah. Oh, there's a S gem and an L gem for any idiots out there that think that he knows his stuff, which I did for about 2 seconds when I started watching him. I'm like, oh, this guy's on TV. He has a popular show. He must know what he's talking about. But some people think he does it on purpose. But yeah, there's a long Kramer fund too. So let's see. And then what was I going to look up? Oh, TLTW. And I know a lot of you are fans of this one, but I'm not in this one. But I have no idea why they just paid out their highest dividend, because from my own analysis, I predicted that it would have been even lower. So I'm waiting, in this case, I'm waiting for one of you to come in and give me the obvious statement, state what I'm missing, which is probably really something simple, that, well, it paid this because of this and that. Because like I said, I'm drawing a blank. Because if you look since February, I mean, it did come back. Maybe this is why, but it only went up a couple bucks from February 32. So that shouldn't have necessitated the higher dividend. So let's see here. But let me just look again here. Historical data. Let's see here. Historical prices, dividends only. And let's see. And what you'll notice is what we went over the other day. See, 64.8 cents as opposed to 30 cents in March, as opposed to 46 cents in February. I mean, I guess I could have seen, because it came back like $2. I could have seen it being a little bit higher, maybe on par with February's dividend, but not the 64 cents. So one of you is going to have to explain that to me. And what's the other one? HYGW? I think that's the one. This is the one that more than doubled. Well, this more than doubled too, but that's like 65 cents. This one was like 80 cents. Now this one, I'll look again just in case I missed something the first time. But if I go for a year, and a lot of these really just debuted, they've only been around for less than a year. So let's see, March 27th. See, it dropped. So I don't see any logic in why the payout was higher. It's a corporate bond buy right strategy. So I don't pay attention to like corporate bonds and the corporate bond market, or any bond market for that matter. But we'll look at dividends only, and you'll see the same thing here. You'll see that this one doubled too. So let's see. And it's not even a year old. It's just crazy thinking back like a year ago, like back in August, I was still in school, doing my dual master's degrees, and it's all over now, just like that, in the blink of an eye. That's how quick things change. Yeah, so see, 38 cents and then almost 86 cents in April. So it more than doubled. So let's see how we're doing on comments here. We've got 9. Oh, we had someone that said hello and someone left. So hello, thank you for that. Okay, so we got 9 of you. I know it is a Friday, so I'm not anticipating a top audience, but that Saturday audience really surprised me. So who knows? What else here? What else do I want to talk about? So I showed those two. So I think I've pretty much covered everything I want. Now, these three, the main three, the TSLY, the APLY, and the OARK, these, we found them to be paying between 30 and 70% dividends. Now, TSLY could drop significantly next month because of the way the stock has gone. I mean, we'll have to see what happens, but 30% is still very solid for a dividend payout. Most of our ETFs that we cover aren't paying that. So anyway, okay, well, I was going to let the comments kind of guide what else I talked about. So if anybody wants to cough up some comments here, I'd be more than happy to entertain those. But otherwise, I'll probably go for about 30 minutes here. So I'll probably go back and let's just look at how the market performed this week. And remember my rule of thumb: if I keep gaining another live viewer, or if the live viewer count goes up, I keep going. So let me go back to the main markets here, because I didn't even follow this close this week. I was just kind of like nose down in my work. So it looks like I think everything was up today slightly. S&P was up, Dow was up, and the market kind of turned later in the day. So yeah, it looks like everything's up. Crude oil is coming down, but it's not translating to the price at the pump, unfortunately. Let's look at crude just for a second here, if it comes back up. Let's see. There's gold and silver. Gold is a lot higher than silver, of course. Crude, let's just look at it, because it was like $82 a barrel. And I'm still stunned that Tesla and Apple trade at the same dollar amount. Who would have thought? All right, let's look at crude oil here. So we were down to like 66.74 on March 17th. What were we? I'm trying to remember where we were March, at the beginning of March. That's so crazy. Okay, this is why this just makes no sense to me, because where I live, March 2nd, the price at the pump for unleaded was like below $3 at Costco. It's like 40 cents higher now, but crude is the same price that it was at then. So something else that makes no sense to me. I guess trying to find logic in it is illogical. Yeah, see, maximum. The highest we ever peaked at was in '08 when we had those, like, that those gas prices were crazy then, from what I was told. And then 2014, it went up, but I don't remember the price at the pump going up that high. Then fracking started, it seemed like, and then crude actually was very low for quite a while. And it seemed like for several years there, not to get on a rant here about the price at the pump, but it seemed like for several years here in this chart here, like no one was even really complaining about it. But then it started going back up here, and it was at 106 in the summer, and it seems like that's where we're headed back to. But like I said, being that the price right now is the same that it was like March 2nd, but yet we're 40 or 50 cents higher at the pump, really makes no sense. So figure that one out if you can while you go play the lotto. What else? Oh yeah, so all the indices were up. Let's see how we're doing here, comment wise. Okay, we got a few others here. Okay, so after you said hello, you said, what's happening with ABR stock? This was my favorite stock. Why? Oh, I love this one. So you must be a relatively new subscriber, because SVOL was my favorite for quite a while. You'll have to go back in my live stream history, because I've talked a lot about SVOL. That one was like the bread and butter. That was like the basic one that I compared everything to. And paying an 18% dividend was really solid, for the price of the fund, which is still around $22 a share. I'll look that one up real quick, and then I'll look up Mr. Bruce Pandoff's favorite stock here, which I've never heard of. But just because I've never heard of it doesn't mean it's not good. But yeah, I'll have to look that one up, because you say that's your favorite. So ABR. I thought that was something else for a second. I was hoping that wasn't Anheuser-Busch. I was going to think you were a troll there for a second if that's what that was. But it's Arbor Realty Trust. Now that one's paying a 15% dividend, so that one looks pretty good. So, well, good job, audience. You all have managed to keep me around longer. If you keep the comments coming and more of you join, I keep going too. Because I'm still trying to hit those watch hours. I'm getting closer every day, but I've got to hit it like by May 1st. I may have a day or so leeway, but trying hard to hit it. So I know all of you all will help me with that, right? Okay, so let's see. We're going to look up SVOL, and we'll pull up ABR on Yahoo Finance. So here we go. Let me see now. Where are you, Yahoo? I've got too many tabs open. Okay, so give me a second here. Live streaming makes me thirsty. You know what? I wonder. I think Buc-ee's is publicly traded. Or is it? Or is it one? Maybe they're not. Huh. That's where my mug is from. Anyway, okay. SVOL for the SVOL fans out there, which there are a lot in this audience. All right, 22.12. That's what it's at right now. This is showing nothing in the after hours, which is strange. We're still holding steady at, I call it an 18% dividend, but it's about 17.83. And that's been around since 2021, so it's about to hit its 2-year anniversary. So there's that. And then let's look up this Arbor Realty Trust. That's a good one that I should actually cover. I've seen that on other channels. So ABY. Oh, I'm thinking about it. Let me look up what's the ticker for Anheuser-Busch, because for some reason I just saw that and thought that was it. Oh, it's Bud, like the beer. I don't know why I thought that. Well, earnings date for Arbor Realty is May 4th. Oh, it gives a range, May 4th to May 8th. So that's interesting. So let's see. Really solid dividend, 15%. 1 year target estimate on this is $16. So from what I can see, just looking at the surface here, this behaves like a REIT, basically. So, and what's really good about these REIT-like stocks is that if you can get the price to appreciate and you get a solid dividend, it's like double dipping. But a lot of times that doesn't happen. So let me go out to the maximum here. Earnings per share is 169. PE ratio is low, 633. Now I have to read the company bio on this one. They've been around since May 2004. They were $30. Let's see what they were. 18. They went up to like 30 and then 31. And then they dropped all the way down to $2. Never really recovered since then, but they've been paying out dividends, I'm sure, the whole time. They were 2011 and 2021. And let's see. May 4th earnings are coming out. Now they crushed earnings Q4 of 2022. Another thing I don't understand is how earnings are just completely off for some companies. Like some companies won't report Q1 until like August or something, which seems kind of crazy. But anyway, market cap is 2 billion. And let's look at the last, let's see, year to date. We fell off a cliff after March 6th, 7th. Wonder why that happened. I'm not sure why that happened. But let me look at the profile. Let me see what they invest in. It may be commercial real estate, because I've heard of it before. And as you know, if I've heard of, well, I'm going to contradict myself here. I'm kind of rambling. I think I just said I've never heard of it, but I actually have. So I misspoke. So don't take my ranting like I'm just kind of, talking out of my rear. But I have heard of it because I've heard of it from other YouTubers. So, and I was going to crack a joke because I have heard of it. That means it's legit, right? Because some people think that way. They're like, well, I've never heard of this. Like take SVOL, for example. Well, I've never heard of SVOL. You say they're paying an 18% dividend. That must be a scam. I'm going to put all my money in CDs, which pays, maybe half of what inflation is. That's the smart thing to do. Lose basically half of my value by being in CDs. I'm a genius, right? That's how some people think. So now that's cool. Look at there. Senior VP, this just caught my attention. Mr. Lee Roth, like David Lee Roth from Van Halen. That just caught my attention there. Now you want to invest in this company, right? Okay, let's see. Only 630 full-time employees. Oh, they're in New York. Oh, they're on Long Island. I was going to say, what are they doing in New York? They need to get out of there. All these businesses need to get out of these high-cost areas. But Long Island isn't as crazy as like the city. Huh. There's an Oakland, New York. How about that? That's funny. Does this map move? I was just looking here. Okay. Arbor Realty Trust invests in a diversified portfolio of structured finance assets in the multifamily, single-family rental, and commercial real estate markets in the U.S. Okay, so it's residential and commercial. It operates in two segments, structured business and agency business. It primarily invests in bridge and mezzanine loans, including junior participating interest in first mortgages and preferred and direct equity, as well as real estate-related joint ventures, real estate-related notes, and various mortgage-related securities. Interesting. I wonder if they do mortgage-backed securities too. The company offers bridge financing products to borrowers who seek short-term capital to be used in an acquisition of property, financing by making preferred equity investments in entities that directly or indirectly own real property, mezzanine financing in the form of loans that are subordinate to a conventional first mortgage loan and senior to the borrower's equity in a transaction. Interesting. Okay, so basically residential and commercial. But some of those CD what is it, collateralized debt loans, debt obligations, and what is it again? The term I just read, mortgage-backed securities. Some of those kind of make me nervous because thinking about like '08 and '09, what crashed the economy then. Uh, those kind of things make me nervous when I see a company investing in those. Okay, any more comments other than the ones we got? Looks like we're down to 9 viewers. Anybody have anything else? Otherwise, I'm about 10 minutes over what I was going to do. So you got about 10 minutes of overtime out of me. But unfortunately, YouTube doesn't pay me time and a half for that. So anybody that locates that super chat feature, that works every day of the week too. And I still appreciate my first one, by the way. Hopefully that was the first of many to come. And I'm going to get the Patreon and all that stuff going too. But for now, that's probably going to be it. So yeah, you're welcome. Hopefully you like that analysis there. So I will see you all on the flip side. Thank you all for tuning in. Like, comment, and subscribe. Spread the word. Thank you all so much, and have a good weekend. And I should be back either Saturday or Sunday. Thanks. Take care.